In our last segment on equity, we're going to talk about preferred stock. Preferred stock is like VIP stock. Preferred stockholders get some preferential treatments. Basically, preferred stockholders will have the first right to any dividends that are declared, and then if the company were to go bankrupt, they would get paid back before the common stockholders do. Because of that, preferred stock is considered less risky. In order to get that less risky stock, you have to give something up, and typically the owners of preferred stock don't have voting rights. That's what they would give up. And their dividends are at a fixed rate. So there's like a capped rate for dividends for preferred stock, whereas commoners have no cap. They could get unlimited dividends. So why would you want preferred stock? Well, because I'd rather have first dibs on dividends potentially. So if dividends are paid, I'll get my dividends first before commoners get anything. Because there's less risk, there's potentially less reward, meaning if the company does really, really well, it's possible that the commoners could end up getting more dividends than the preferred stockholders. It's really just a way to appeal to a different type of clientele. So if you think of an airplane that has first class seats and coach seats, why do people fly first class? Because they want the additional comfort, they want the better food, they want to get on the plane first and get off first, they want those perks. Well, it's the same with preferred stock. Certain people wouldn't fly coach, so by offering first class, we appeal to that type of demographic. Likewise, certain people don't want common stock because it's too risky for them, so by using a different class of stock, we can appeal to a different type of investor. An investor that likes a little less risk, likes preferential treatment. Before we get into the details of preferred stock and how it works, just really quick, remember that we live in a world with many different countries. U.S. GAAP uses certain terminology for equity accounts. Common stock and additional paid-in capital are the ones that we're most familiar with. However, internationally, those same accounts have different names. So common stock is called share capital, and under IFRS, an additional paid-in capital is called share premium. So remember that though in this class we're focused on U.S. GAAP, international standards do exist, which differ slightly from GAAP in some ways. Sometimes it's simple, like this example, where it's just in the name. Other times it's in the way that transactions get recorded. We're not focused a lot in this class on IFRS, but I think it's important to remind you periodically about some of those differences. So back to preferred stock. Preferred stock offers a dividend preference, as I already mentioned, first dibs on dividends. So there's a current dividend preference, and that's VIP stock, where the company, if they pay dividends in the current period, preferred stockholders get the dividends before commoners get anything. A super VIP type of preferred stock is one with a cumulative dividend preference, which means that if a company doesn't pay dividends in prior years, the prior year dividends accumulate, and they're referred to as dividends in arrears. Well, think about where your rear end is. It's behind you. So dividends in arrears are dividends from the past that haven't been paid. All of those prior year dividends need to be paid first before the commoners get anything. So a cumulative dividend preference is a much better type of preferred stock. If the preferred stock is non-cumulative, any dividends not declared in previous years are lost and never paid. So you get first dibs with non-cumulative dividends, but first dibs on zero is zero, and you never get that money. In the next year, if a dividend is paid, you get your dividend first as a preferred stockholder before commoners get anything. If it's a cumulative dividend preference, you're going to get paid any prior year unpaid dividends before the commoners get anything, so that is much better. Dividends in arrears are disclosed in the financial statements. They're not a liability until the board of directors declares the dividend. So we just disclose them. They're not a liability because, remember, dividends are not required, which means if a company never pays dividends, even if you have a cumulative dividend preference as a preferred stockholder, you're never going to get paid. That's just the way it goes. So let's look at an example of how this would work. So if we have preferred stock, 6%, $20 par, 2,000 shares outstanding, the first thing we need to learn to do is how we calculate a preferred stock dividend. A preferred stock dividend is going to be the number of shares outstanding times the par times the dividend percentage. So in this case, it's going to be a $20 par times the number of shares outstanding. I'll do it in the order I wrote the equation. 2,000 shares outstanding times $20 par times 6% is going to give us $2,400. So that's what the preferred stockholders are entitled to each year before the commoners get anything. If Wally issues a 3,000 current dividend, the dividends are allocated as follows. Preferred stockholders would get their $2,400 and the commoners get the leftovers. If Wally issues a 30,000 dividend and the dividends were in arrears for 2 years, assuming we have a cumulative dividend preference, then preferred stockholders are going to get their current year amount and the 2 years that they're owed from the prior 2 years that have been unpaid before commoners get anything. So the best way I like to set these up is I like to go total dividends declared minus the current year preferred stock dividend minus prior year unpaid preferred stock dividends, but this only applies if the preferred stock is cumulative, and then that finally equals the leftovers for common stock. So in our example for number 2, they paid $30,000 in total. The preferred stockholders each year are entitled to $2,400, so the current year preferred stock dividend is $2,400. Because it's cumulative and there were 2 years of dividends in arrears, we owe them $2,400 times 2 for the dividends in arrears, which is $4,800, and then that leaves the leftovers for common stockholders at $22,800. The preferred stockholders get a total of $7,200, $2,400 from the current year, $4,800 from the prior, and the commoners get the leftovers. The only difference would be if it were non-cumulative, then we would have, and I'm just going to erase this because you have the ability to rewind if you like. We'd have the same setup, so we'd have dividends declared worth $30,000. The preferred stockholders would be entitled to $2,400. But if it were non-cumulative, then the prior year unpaid dividends would be irrelevant, because if it's non-cumulative, even if there are unpaid prior year dividends, you don't ever get that money, so that would be 0. And then that would leave us with the leftovers, and the leftovers in that case would be $27,600. And that's how much the common stockholders would end up getting. So it's very important you read a question carefully when it comes to preferred stock. You first need to know, is it cumulative or non-cumulative? That makes a big difference. And then also read the question carefully to determine if it's asking you for the amount of preferred stock dividends or the amount the commoners get. If we're asked for the current preferred stock dividend, it would be $2,400 in this non-cumulative case. If we were asked for the common stock amount, it's $27,600. So you want to make sure that you check for 2 things. 1, what type of preferred stock is it? Is it cumulative or non-cumulative? And 2, what is the question asking you for? The amount the preferred stockholders get or the amount the common stockholders get? Lastly, we'll talk about how the stock transactions affect cash flows. You may remember we said that the 2 ways a corporation finances activities is through debt and equity. In other words, A equals L plus E. So we can finance our operations with E, equity. So all of the transactions that we talked about in this chapter end up in the financing section on our cash flow. So when we issue common or preferred stock or buy it back, it's going to be a financing activity. When we pay cash dividends, it's also a financing activity. Notice that stock dividends and stock splits don't show up here, and that's because they don't involve cash at all, so they would have no effect on the cash flow statement. So it's really important that you remember the 2 ways we finance a business are through debt and equity. So our debt and equity transactions end up showing up in the financing section of our cash flow statement. And that's it for our chapter.